Hello, everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moomoo Technologies, and I'd like to welcome you to our latest live event with Stephen Sarge Guilfoyle. Now, Steve, good morning. How are you today?
I'm feeling pretty good. Yourself, Jerry?
Cannot complain. Thanks. Steve is our markets commentator here at Moomoo, and you can check him out every market day on our community under the handle Invest with Sarge. He can talk to you about fundamental analysis, technical analysis, options, and today's topic, I should say, growth versus value investing. Now, a lot of us hear about growth stocks, value stocks, but not everybody knows what that means. So Steve is here to explain it. In a nutshell, growth investing means investing in stocks or growth stocks, which tend to be rather expensive relative to their earnings, but that you believe have a bright future. Maybe they're in a hot technology sector and they're going to go up quite a bit, you hope, and therefore you will make money. Value investing is the opposite. You are buying stocks that are inexpensive relative to their earnings, but you think, you believe, you hope that they will catch up and get the ship right, and you'll make money that way. Which is better? How do you invest in both? What do they mean? Let's talk to Steve about this. Now, Steve is a markets commentator, as said here at Moomoo. He is also a former floor trader at the New York Stock Exchange, a staff economist at several firms, and is a current columnist for the Street.com Pro. And yes, he is also a former sergeant in the United States military, so that is why we call him Sarge. Now, before we get started, I'd like to invite you to join in the conversation and send a question to us via the chat function of this video. If you send us a completed question, we will give you 100 Moo points just for doing so. And if we use it on air, we will give you 1,000 Moo points. So send those questions in now. Now, Steve, while we wait for some questions, let's talk about this subject. Why don't you explain a little bit more about what growth stocks are, what value stocks are, what are the potential? Let's start with growth stocks. What are the potential pros and cons of growth stocks? How do you define a growth stock, et cetera, et cetera? Give us the 411.
Well, growth stocks are basically, I mean, you said it just a few minutes ago. Growth stocks are companies, stocks of companies that can grow their sales faster than normal, faster than the S&P 500. In my mind, I look at companies with year-over-year growth of, say, 20% in revenue as growth stocks or potential growth stocks, regardless of whether they're profitable or not. Value stocks, on the other hand, is a stock that you think, based on its fundamentals, might be worth more than the market is assigning it. It might be in a sector that's growing at a pedestrian rate, so the market has not assigned such a great value to the stock. But based on its cash flows, based on things like a dividend it might pay, what it returns to shareholders, you or I might see value in that stock, and that's why it's called a value stock. They're both. I layer my book with both. I see significant value added, not to play on the word, from both types of investing. One, you feel pretty safe with the value stocks. You feel like you can't get hurt too bad, but maybe your profits are capped, but perhaps they return some income to you. Growth stocks, on the other hand, you're really playing trend. You're playing trend more than anything else. You're using technical analysis on the growth stocks more than fundamental analysis, where with the growth stocks, you're using fundamental analysis more than technical analysis.
Great. Now let's talk a little bit about growth stocks first. Now, those seem to be the ones that have been for many years popular. Hot tech stocks. Sometimes you get some biotechs that aren't making any money now, but they've got some potential breakthrough cancer drug or something like that. Could be huge in the future. When you're looking at a growth stock, when one of our users want to look at a growth stock, first of all, how do you define it? Is it price to earnings ratio or what have you? And what are some measures to say, okay, well, this is a good growth stock versus, we're not so sure about this one. Why don't you give us a rundown of what you would look at to define a growth stock and what type of, as you said, fundamental indicators or what have you, that you might look at to decide, well, this is a good stock or bad stock or what have you. What do you recommend or suggest?
I look at sales growth, the year-over-year pace of sales growth. I look at sales to book, sales to earnings, PEG ratio, the rule of 40, which for folks that don't know what the rule of 40 is, it's sales growth plus margin, plus profit margin. If those two add up to 40 or greater, well, then you can kind of think it's probably a growth stock. And in some of these growth stocks, you'll see they might even have a negative margin, but they'll have something like 70% sales growth. So they'll reach the rule of 40, even though they're currently burning cash.
And use the term PEG ratio, that's price to earnings to growth ratio.
Yes.
Talk a little bit about that.
It's just another way of measuring the quality of the equity in a stock that because it is a growth stock, you don't want to just value it based on a per earnings ratio, a forward looking or trailing 12 price to earnings ratio, which is how a lot of older investors, folks my age and older, actually look at PE ratio before anything else, because for so long when we were younger, there we all knew what the average S&P ratio for the forward looking S&P ratio for the S&P 500 was at any given time. And before things got so complex and we got so sophisticated in our thinking, we would look at a stock and say, okay, well, this one's trading at 11 times. The S&P is trading at 15 times. It must be undervalued. It was a simpler time. We didn't have the internet. You read Barron's every weekend, and you thought you were pretty intelligent because you did so. So obviously, thought processes have evolved over time, and you investors and traders of today have a wealth of information that we really didn't have. Honestly, folks, we used to chart stocks on graph paper once a week because otherwise you'd spend every living moment charting stocks. Now you want to look at a stock, 10 different stocks, look at their charts. You can probably make some kind of technical analysis on all those stocks within an hour, even if you go in deep, just because you have a computer at your terminal, where in the old days, you spent half of your Saturday going through your notebooks and making adjustments to charts that you had going back over years.
Great. And I point out to our users that most, if not all of the indicators we talk about, such as P to E and PEG and things of this nature, you can typically find on the Moomoo app under a quotes page for a specific stock. And let's just talk a little bit more about P to E, price to earnings ratio. Is that what determines whether something is cheap or expensive? So for instance, I looked up NVIDIA yesterday, and its trailing P to E is about 79, or was, versus the S&P is about 20-ish. So relatively, that's a growth stock. That's an expensive stock. Is that the sole determinant? Is the PD is higher than the S&P, or the PD is lower than the S&P? That's a value stock.
Let me take a look for you. I think the PE ratio on that one, forward-looking PE ratio, is a
I was
lot
looking at
lower.
trailing. I apologize.
Yeah, forward-looking is 37 times. So
Okay.
that's much more realistic, and that means they are pricing in some deceleration in sales growth because yes, I'm long the stock while I'm speaking about it, so I should mention that. But going into these earnings, which will come out tomorrow afternoon, I think now that they're pricing in a decelerating but still aggressive sales growth, I think I'm thinking a little more optimistically on the name. That's why I took some profits, but that's not why. But I didn't get completely out, and I think that it still is. Yes, it's a growth stock because the profit margins on these high-end AI capable chips that they've been selling are just fantastic. So even if they slow down a little more on the growth, as let's say an AMD or a Marvell Technology catches up in terms of market share, I think that their margin will maintain that rule of 40 easily.
Let's talk a little bit about the flip side, which is value stock. So a value stock, what can you look at with that? I mean, the price is down. Someone doesn't like the stock, or else the price would be up relative to its earnings. So what do you look at with a value stock to say, oh yeah, this is a great deal, or maybe a great deal, versus, uh-oh, this company is in big trouble and it's down for a reason?
Yeah, always be careful with that. Like some semiconductor stocks, even though they're in technology, will always show a very low PE because it's such a cyclical business. So you want to be a little wary of that. Typical value sectors would be like financials and energy. Now, energy, they make a lot of money. They push a lot of free cash flow. These are the metrics you want to look at. If your oil stock is driving great cash flow and returning cash to shareholders, that might be why you're in the name. Not so much for the price appreciation of the stock, which you want, but because they're returning a lot of cash to you. It's an income stock. That's a perfect maybe investment for a guy my age or older, and maybe not so much for a 25-year-old trader. Financials, you want to look at balance sheet health. You want to look at loan quality. You want to look at their important tier ratios. As the Fed has set forth, make sure they can maintain their certain level of reserves that they have to keep in order to remain in compliance with the Fed. You might want to stay with the very large banks rather than the regionals, given what's going on with real estate right now, because the large banks have less exposure relative to their overall book. But those are examples of of sectors that are trading, let's say 12 to 13 to 14 times versus the S&P 500 that you just mentioned is trading, I think, at 20.7 times right now. So yeah, I guess they call it a barbell approach, and not the traditional barbell approach that we've been talking about for a year or two, but in terms of your equity allocation, you might want to put a few shekels in growth and a few shekels in value, and see if you can get some kind of balanced return.
It's a good point, but quick point. When we talk about returning capital investors, we typically mean either the stock pays a dividend or they're doing a share repurchase, which can push the price up for those.
Yes, and let me point out that's something that investors should probably pay attention to more, and the traders not so much, but investors certainly. When something returns a beefy amount of capital to shareholders, that's nice, and it might drive up the shares. But if they are returning a lot more in the form of repurchases than they are in the form of dividends, the dividends direct you, the investor, directly. The repurchases might support your share price, but they, let's say, do a little bit more for the C-suite than they do for the average investor.
That's a good point. So you touched on one thing, and I want to get to our question soon. I'm just going to ask you two more. So do you typically pick one style or another if you're an investor, or do you do both? And any thoughts on, does one outperform the other historically over the long term?
Well, I do both, as I mentioned. Recent historically, yes, growth has outperformed value by a significant margin over the years as we've gone into the more Keynesian model of monetary policy, as we've done a lot more deficit spending, and for most of that time kept interest rates very low. Growth was, because money was cheap, and money was plentiful. Growth was favored over value. Now in this era where things like dividends and yields seem to be a little bit more important, you've seen the performance of utilities of late, right? The top performing sector over the last couple of months. Is that a hedge against inflation? Is that a hedge against electricity inflation? Or is that simply growth being favored over value? And because algorithms move a lot quicker than we ever used to, things happen in months now instead of years.
We got some great questions from the audience ahead of this broadcast. We'll start with those, but feel free, folks, to send us a live question now. We'll try to get to as many as well. Mr. Kashka also asked about NVIDIA. I never know how to pronounce it. Do you see that as a growth stock? I understand they're the market leader of the moment, which is pushing the stock price sky high, as no one wants to miss the boat. But chasing a stock just because the price goes up is a dangerous game that can end badly. Now, without getting into a specific pro or con on NVIDIA, or let's talk a little bit about the flip side, which is a growth stock. It's going through the roof. Are you overpaying? How do you try to protect yourself from overpaying? When do you think about selling? What advice do you give, or thoughts do you give to people about that?
Well, this is a real danger, because when I'm investing, I do set target prices, and I do make sales at target prices. I don't sell my entire position, very, very rarely anyway, but I do make sales. So in a stock like NVIDIA, what he mentioned, yes, that's a growth stock. We've pretty much decided that. I still am long some, as I mentioned, but I'm not long nearly as many as I were when NVIDIA started rocking last year. So yeah, I'm probably a little light right now, and that tends to happen. But in order to reinforce your code of discipline as a trader, as an investor, I do think you have to make decisions at target prices and at panic points. You just can't let it go, because if you let it go once, you let it go another time, and a time after that, and sooner enough you get hurt. So, and I don't think you should chase, if that's what was your, I think, part of his question, right? I don't chase these stocks to the moon. When they're running, I sit tight. Hey, I mean, in percentage terms, you look like you made a great purchase, right? Because you own the shares lower, it's running, you're not chasing to add to it. If you're trying to initiate, I would be real careful about initiating when a stock's making new highs. I would rather just play something through the options market than chase the equity, something like that. Put on a bull call spread or something like that. This way, if it doesn't work out, the cost to you is much smaller than it would be if you've actually bought the stock.
Anything you should mention options? Bellwether asked, when trading options contracts on value versus growth stocks, since big earnings pops aren't as common, I would say that's more in value stocks, not growth stocks. Well, no, actually earnings pops, not price pops. Anyway, I'm going to start again. When trading options contracts on value versus growth stocks, Since big earnings pops aren't as common, which strategies are favorable? Now, of course, you can't give a specific recommendation without understanding everyone's personal financial situation, but let's just talk a little bit about this subject in general on options contracts on growth and value stocks. What are your thoughts on that?
Well, if you're expecting increased volatility, you can look at how much things like straddles and strangles cost right now. If the implied volatility is greater than how much the combined cost, the combined debit of a straddle or a strangle would cost the investor, well, then if you think the volatility is going to be high, you can make that expense, or you can put on a directional spread, which is an all or none strategy, basically, because if you're in the wrong direction, you're going to lose it all, lose everything spent on the option spread. And if it goes the right way, it'll work out for you. And you can sell these strategies either. If you think it's going to be less volatile, you can get short a straddle, short a strangle, or put on a reverse spread. This way you get the payment up front and you buy the protection at a lower price. It's really a matter of your personal opinion, of the trader's personal opinion on the individual equity, and if they think the options markets are mispriced. I will warn traders that options markets have never been more accurately priced than they have become the last few years, now that algorithms are trading them and not people. Even though I am a big fan of human beings, the algorithms do sometimes outperform us.
That's great. I like human beings myself. All right, great question here. How do macroeconomic factors such as interest rates and inflation influence the performance of growth stocks and value stocks? We're talking about looking at the stock itself, but meantime, you've got the Fed doing stuff, you've got inflation and all sorts of things going on in the macroeconomic factors. How do those play into, let's talk about first growth stocks and then value stocks?
Well, I mean, the obviously the forms that are capital intensive, which most growth stocks will benefit more from low interest rates and a lot of a very liquid capital environment. So that favors the growth stocks, but the value stocks will still benefit in that environment. And as monetary policy tightens, I think maybe then you see the value stock to catch up a little bit. You haven't seen, until the last couple of months anyway, you really haven't seen the growth stocks get hurt as the Fed tightened short-term interest rates over the past year and a half. And that probably is due to our overly liquid environment. You got to remember that the Fed blew up the balance sheet. Every central bank in the world blew up their balance sheets during the pandemic and after the pandemic. And even though they've been going through quantitative tightening for quite some time now, they're still nowhere near where they were in early 2020 in terms of the size of the balance sheet. So there's still a very liquid monetary environment, even if interest rates aren't that low. And that's why there's a debate right now whether interest rates at these levels are actually restrictive or not.
All right, next question is from Young Mi, if I'm pronouncing that correctly. Great question here. How do we achieve success by combining the approaches of growth investing, represented by Cathie Wood, and value investing, represented by Warren Buffett? Now, that raises a good point. Cathie Wood, very famous, known for buying what she considers growth stocks, kind of high risk, high reward types. And Warren Buffett, fairly historically known for being a value investor. Another name to think about is Ben Graham, the late great, who is a famous value investor that Warren Buffett said influenced him greatly. But how do you achieve these sort of successes or combine them, or what are your thoughts on that?
Well, I mean, I'm not quite the investor Warren Buffett is. I'm
I
probably
don't
a better
know.
trader than Cathie Wood, to be honest, but but that's not her thing. She's investing in the future. So yes, while she trades that, she probably should hire someone else to trade it. But I'm not really taking a shot at her because I understand what she's trying to do. And one of my highest conviction trades right now is a highly speculative name. So I do get where she's going. But I mean, to rely on, I guess this might come down to an age thing. I mean, if you want to do both, I want to do both. Value invest and growth invest, and invest in the future while also being invested in the steady cash flows and the pedestrian growth that some of the value names offer. So I think you really want to try to straddle the line or use the barbell approach that we mentioned and try to do both, because you want to get those outsized gains when they do show up. And maybe you're willing to take that risk, especially as an under 30 something or under 40 something. Maybe you're not so risk averse. You're willing to go lean a little heavier into the Cathie Wood style. But when you're my age or older, or even a little younger than I am and older, I think that's when you start leaning towards the more predictable rate of return that Warren Buffett offers you.
All right, great. Next question is from Wonder. All right, growth and value seem to be intertwined. If a company is in the growth stage, is it likely to have good intrinsic value? Interesting question. A lot of growth stocks, hard to generalize, but again, if something is a growth stock, people seem to like it, someone likes it. And the question is there a good intrinsic value, or how do you measure the intrinsic value?
It's actually an excellent question, and it's very hard. It's very difficult to answer. A lot of folks will notice that when a growth stock is in that sales growth phase, I mean, it trades at ridiculous multiples. It's just out of sight. And then once they start to become actually a better company and they start turning a profit, that's when investors realize that the PE ratio is something ridiculous. And that's actually when you start seeing the profits being taken. So yes, there is a point when these companies reach a point where they are profitable and they are starting to be judged like normal companies or value companies, but probably more like middle of the road companies. That's when they have the hardest time seeing further appreciation in their stock prices. So when you notice that sales growth is starting to slow down, maybe not down to the average, but starting to slow down, and the free cash flow is becoming actual positive free cash flow, that as a trader, that might be a warning sign to take a little. You might want to stay invested in the name if it's something you believe in, but to take some of your chips off the table.
All right, great. Let me ask you a question. I'm gonna use moderator's privilege here and ask you one. Steve, when you look at a stock, it is a growth stock, how much should someone go and say, hey, that's a cool technology, that's a cool drug? I look at a lot of biotechs, and of course, every one of them sounds like it's a breakthrough. Unfortunately, many of them wash out. But how much do you use your own knowledge, intuition about, well, that's an interesting AI concept or piece of technology or something? How much do you put into that when you're looking at a stock as more of a longer term investment? Does that play into it or not?
It certainly does. For me right now, that's one of the positions I was mentioning before, which I don't really should not mention on the air, so I won't. But there's one big data software / AI company, you could kind of think about what it might be, that I have been investing in because I think they sound so much smarter than everyone else, and I think they are ahead on the AI game. Even though they're not properly valued from a value standpoint, this is one name that I have been accumulating that I want to end up with a large position in. And I'm not thinking of myself with this one. I'm thinking of my children and grandchildren. So yes, there are times when you spot something that you think is unique and affordable for now, and you have a feeling that it's so unique and that perhaps even if it doesn't go to the moon and you get rich, it'll at least get taken out by somebody bigger, by a bigger fish at a multiple of its current sales price, market price, which would be just as fine as far as being a trader or an investor goes.
Great. Next question is from Dada Kai, if I'm pronouncing that correctly. Hi, Sarge. Given both approaches have pros and cons, how should we decide on the weighting of value versus growth stocks in one portfolio? So some people may go 50-50, some people may go 99-1%. I mean, it depends on the individual, but give us some thoughts about how to decide how to break up your portfolio that way.
Yeah, I actually change my mind on this a few times a year. So it's not something you have to have a set rule in. Like right now, I'm heavily invested in the inflation trade, which is basically a lot of commodities-based ETFs. And they were not in my portfolio prior, so I had to make room for them. So I cut back on both my exposure to growth and my exposure to value because I consider this a separate trade. So yes, I think you should have defined levels of exposure. But I think it's perfectly fine if you adjust those on a regular basis. You don't have to wait for a quarterly readjustment, although that might be easier if you do something else occupationally, and this isn't exactly your cup of tea. But if this is something you do often, I see nothing wrong with at least having an idea of your exposure. And then you have to follow it, because if something takes off or something becomes undervalued in a name you have invested in, that could throw your whole allocation off. So you may need to take a profit somewhere or add somewhere else, or both, in order to keep your allocations in line with how you set out. But it is something I definitely think you should be mindful of. Yes.
And you've talked about before, when you enter a position, at the beginning, this is you, someone may do it differently, where you would exit on the upside and where you would exit on the downside. And that's something you recommend. I mean, Do you just throw a percentage on it, or do you do a lot of research, and how's that work in
Well,
your?
I do my fundamental research, and then I do my technical research, and I do both. And I look at economics to see if the economics support the business as well. I basically look for a technical setup that I'm comfortable with, and a name I've already decided was fundamentally worthy. And if I see the technical setup, then I will look at how this stock has acted. Now you have to go back. This is work. You have to go back and look at past setups for this stock, specific stock. It doesn't have to be the same setup. It doesn't have to always be a cup with handle or a double reversal or anything like that. But you have to go back and see how it has reacted in past breakouts, past pivot points, because each setup has a pivot point. And so if this stock typically breaks out 15% when it goes past pivot, well, it's as simple as that. I'll put a 15% premium on the pivot, and that's my target price. As far as panic points go, as I've told Jerry before, I simply refuse to take a greater than 8% loss on anything ever. So that comes from experience. Way back during the .com bubble and crash, I lost something like 96% on a stock. So that's when I made that decision. And so basically, when a stock is down 8%, I'll let myself try to wiggle out of it if I think I can by buying more and bringing down the average price, but I won't let myself do that more than once. And if I still am down 8% after trying that method once, that's when I'll say, okay, I got this trade wrong, and let's move on.
I lost about 100% on a couple of .com stocks, Steve, so don't feel bad. All right, next question. We're running low on time, but too many scammers. How do we calculate fair market value in value investing? We talked about this a little bit, but of course, is a stock a great value or is it going to zero? That's tough to determine. What are some things people might look at there?
Well, you look at the per earnings ratio, forward-looking per earnings ratio relative to its sector, not relative to the S&P 500 or any kind of broad market index. So, like I said, I think financials and utilities are trading around 12 times right now. You would look at them to trade at 12 times, or not 20 times like the S&P 500. I think you want to look at cash flows. That's so important. A lot of folks don't realize that. Look at the statement of cash flows. If they don't provide the information, they should provide you with a statement of cash flows in their filings when they report. And that will tell you really precisely if the business is providing cash flow and if less capital expenditures is providing free cash flow. That's more important actually than profitability, because that will keep the engine burning. That will tell you if they're burning cash or if they actually have a business that can become quite profitable and maybe appreciate in share price.
Let's squeeze one more in here from LL9542. Can you share an example of a successful growth investment and what factors contributed to its success? Now we can probably, since we're talking in the past and historical, can you think of anything that was a good play for you in the past of a growth stock? And looking back, what did you learn that pointed that this was going to be a good investment?
Oh, over the past several years, almost all of my huge winners have been semiconductor stocks or software stocks, and that's been really due to the explosion in the data center, in now artificial intelligence, but before that, electric vehicles. It seems like every new craze, I don't want to call it craze, but every new thing that comes out that markets get really excited about is a higher and greater technology that requires greater computing power. And so these businesses, it seems like there's almost an inelastic demand for what they do. I'll throw cybersecurity stocks in there also, because there's almost, even though Palo Alto had a tough night last night, I don't own any, so I can talk about them. Palo Alto had a tough night last night. That'll probably drag down the group today. But I do really like, and I own a couple of other cybersecurity stocks. So as Palo Alto weakens that group today, I will look to probably increase my positions in a couple of other names in that group that I think might be a little more squared away than Palo Alto. So yeah, I got a little off track, but yes, it's been almost all in technology the last several years, what has really worked out well as a growth stock. But when you see opportunities like this, I also think you must strike.
All right, great. I wish we had more time to talk. We got to most of our questions. Thanks to everybody for sending them in. We hope you'll check us out on our next video. And we hope you'll check out Sarge every single trading day and invest with Sarge on the Moo community. He will try to answer any questions that you have. Steve, thank you for joining us.
Thank you.
And everybody, best of luck today investing and in the future. Check us out every day on the Moo app. I'm Jerry Cronenberg. Thank you so much for watching.